Welcome, Bill Mervin, with the mortgage team at NJLC Lenders. Bill, I'm excited to talk to you today.
So to talk to you, Maria. I've been looking forward to this for a while now. So
Awesome. Well, I'm excited to have you on. Let's dig in right now and bring value to our listeners. So, interest rates, it's all the rage. People are been talking about it all year, waiting for them to come down. We have seen an adjustment in the last couple weeks. But Bill, it's not moving the needle for these buyers to get off the fence.
yeah, that's they're definitely. I think even probably the last 6 weeks, although it's really kind of accelerated over the last 2 or 3 here. Um, just a little background on the rates. A lot of our conversations that we have with folks is kind of just kind of helping them. I think that when people don't understand things, then they naturally kind of fill in the blanks themselves, right? Or they go kind of like to a worst case scenario. And, one of the biggest things that drives me nuts is, when mortgage people or real estate people are online saying, hey, get in and lock in your rate before the Fed raises interest rates, right? As if the Federal Reserve controls interest rates. The biggest dynamic that drove interest rates up, this like massive kind of surge in interest rates that we saw from late 21 through 22 was, and actually into this year, was inflation, right? In
Yeah, for
2021,
sure.
Fed was talking about transitory, this transitory was going to come and go. The Federal Reserve was saying that we're not going to hike rates for another year or so, and then the next meeting they started hiking rates. So as they often do, they missed the mark, and inflation took off, right? And inflation, by far, and this is important to kind of get into where rates might be going. Inflation by far is the biggest driver of interest rates, right? Because if I'm a lender and I give you a 4% fixed rate, and everything is rising at 8 to 10% annually, the price of everything else, as it was, 12 months ago, let's call it, then I'm losing my shirt on that 4% interest rate. So interest rates naturally have to go up to account for that inflation, which is eroding the value of that fixed interest rate. So that is what drove interest rates up. And the Federal Reserve is really like, I don't know if the right saying, the tail wagging the dog, right? As inflation kicks up, the Federal Reserve only controls that short-term interest rate, the federal funds rate. So they had to hike it up. And the idea, and they'll never outright admit this, is that by raising the interest rates and making the cost of borrowing more expensive on car loans and credit cards and student loans and the such, the idea is there's less money then in the economy to spend on other things. And when there's less money to spend on other things, demand goes down. And when demand goes down, inflation comes down. So,
And prices.
exactly right. So as a component of
I mean, they've
inflation.
really had to stop the housing prices just have went through the roof in the last couple of years. In
Well,
the metro market, they're up about 37%, which is a significant amount in just a short amount of time. When we look at the increase in home value to be typically about 3 to 4% per year
annually, yep.
over the last 40 years.
Yep. And it's taken off. And here's the thing, right? And some might accuse me of being, an industry insider who, wants to make everything the right time to buy. But, certainly in my business, there's many times we'll tell people to be patient, specifically with refinancing and different things like that. So I'm not afraid to tell people now is not a good time, but I'm a very, very strong believer that now is a great time to buy. And that ties into kind of what we're talking about here, which is, rates. So, the housing took off, right? And I did a video back in early pandemic, when everybody thought the sky was falling and realtors would never sell another home. And I said, I did it on YouTube about, the optimist case for COVID, and talked about all of this stimulus spending that was going on, and how when people got out of this lockdown, that I thought we were going to see a really big boom in the housing market. And I for the folks that talk about a bubble, the talking heads and the clickbait, media online that scare a lot of folks, having lived through the 2006, 2008 period, there's no similarities, right? So a couple quick points. In 2006, we'll call that the last actual real estate pullback. There was over 4 million homes on the market in the nation. Now we've been banging back and forth between 800,000 and low 1 million. So almost a 75% decrease in available homes. New housing starts that are built. We had almost a decade of well above the long-term 50-year trend. And now we've had 14 straight years below that long-term trend. And as we were getting back close to that trend, now it's pulling back again because of the cost of labor, the cost of material. It's especially at affordable price points, it's tough to build homes. So I think the supply and demand kind of mechanism in real estate is broken in a lot of markets. And on the demand side of things, in 2006, we had the smallest generation of first-time buyers since the 1920s. And today, we have the largest generation since the baby boomers, and it's pretty close. And actually, for the next 5 years, that number, that kind of median first-time buyer age, that pool of buyers is actually going to increase for each of the next 5 years. So I think supply and demand is completely broken in a lot of these markets. And then the final piece is that in 2006, when there was all these 0% down loans, so as soon as you did start to see any issues, you had all these forced sales, right? People were effectively underwater, which means they couldn't sell their house because they owed as much as the house was worth, or effectively were when you took into commissions and stuff like that. And then as soon as a house got forced sale and sheriff sale, it depresses the values, and then it pushes more people underwater. And it was this kind of fueling situation. Whereas now we've got the greatest amount of equity in homes in U.S. history. So if there are people that hit financial troubles, they're not going to get forced into foreclosure. They're just going to hit the market and sell their property and come back to fight another day. So I don't see any of the setups for lower real estate prices. And people said that 6% was going to break the market. It didn't. People said 7% was going to break the market, and it didn't. And understand, and you're seeing it firsthand, there's pockets where housing is a little bit slower, but generally speaking, if a house is desirable and priced right, many of those are still selling very briskly, right? And so to get back into a rate discussion, if homes are still selling with this much, because the supply and demand is so out of balance, at 7 to 8% rates, how much more demand is there at 5 or 6% interest rates?
I think the issue really comes to, if you currently own a home and you want to move, you have 84% of people under 5%.
Yep.
So they don't want to trade a 5% for a 7% and pay more money for the house to basically get the same house that they have, again, with a bigger mortgage payment.
The lock-in effect. Yeah.
So those people, they have to sell so there could be more first-time household formations purchasing property. So that is causing stagnation of deals to go through because of the so much less inventory than there has been on the market due to the middle part, the second home buyer, move-up buyer, not purchasing unless they're moving to another area for relocation.
You have to move. Yep.
So I looked at a lot of our sales that we had on the buyer side. A lot of them, the sellers are baby boomers. The sellers are moving to their forever home, either out of town, out of state, in some cases locally into the Jersey Shore, to Florida, some, 55 and over communities here in Pennsylvania. But that is the majority of the sellers.
Yep.
Is people moving either for work or baby boomers. And so they're not as affected by the rate because a lot of those folks already own their homes outright, right? Yep. So they just want to get in their forever home. They don't have that many years left.
Yep. At that point, it's driven more by either the absolute need, relocation, or, and you're entering that phase, I assume, with retirement. It's about, you're not really worried about necessarily, not that it's unimportant, but the financial side of the equation. You're looking at it more as, where do I want to spend these years, right? And so you're not as as impacted by that.
Yeah, you have more urgency
Yeah.
than somebody maybe like myself who, yeah, I'd love to get a new home, actually. But is it an absolute need? Not really. My office is a 7-minute walk from here, right? It's easy. So it'd have to really be the right circumstance to pick up and move to a different location and all the aggravation that comes with it.
Yeah, I mean that lock-in effect, as you're describing, is it's taking what has really been a kind of a brewing inventory crisis. I was looking back on my Facebook feed of these different posts, and I did this like in 2018 or 19. It was like inventory. It was just a post about lack of inventory then, right? And it's funny because now we look at it and there was quite a bit of inventory compared to where we are today, but it's just been kind of brewing along. And yeah, that lock-in effect, as you're describing, where people have lower interest rates. So when you look at the move-up cost, when you look at the price of homes, and then the increase in interest rates, it's causing a lot of folks to just stay where they're at. And
Yeah, and it's more too, right? Because every house, I tell every client, you need to factor in painting it.
yeah,
I don't care if it's a brand new build, it's still going to need to be painted. So you got to have a
absolutely.
number for that. You're going to get everybody does this. You're going to get some kind of new furniture. You might get a new bedroom set. You're going to need all new sheets. If it's a different size bed and maybe you want different comforter. I mean, these are expensive things.
Yes.
Things, I look at even cost of buying a pair of shoes. I mean, or a expensive bag. Those all went up by 25%.
Everything.
Something that cost me $300 or low threes is now in the mid fours for a pair of shoes. I couldn't even believe it when I went to the store. I was like, these used to be a couple. Anyway, so everything costs more, right? So the cost of moving even costs more.
Yep, you're right. And it's when this, not to digress far, but it's, even with inflation cooling, the gains that were there are already there, right? And, that's a whole nother can of worms to open about how big of a thief inflation is. But yeah, I mean, everything is just so much higher than it was before. So yeah, I mean, it's given a lot of people pause, and I don't see any quick fix for that. I do think that there's an aspect where, in some cases, good education and good, kind of preparation to kind of, like I talked about, where if people don't know or nobody actually shows them the way, they're going to want to default, especially with a big decision like this, to the most conservative kind of approach. And, the question I ask a lot of folks in these types of discussions, because sometimes our discussion is with potential sellers, even though we're on the financing side, because we want to help our agents, kind of, if there's an opportunity to get that person motivated to sell, to do so, right? And so some of that is them understanding the numbers of what it could look like moving forward. And if you're one of these folks that doesn't have a high motivation to sell, right? And you say, could you see yourself in this house 5 years from now? And if the answer to that is yes, then that's a tough hill to climb, right? There's not a whole lot you're going to do to overcome that. But if this person does see a need to move in the next 3 years or 5 years, and it's just that immediate fear and anxiety that they have at this moment, that's where I do feel there's some opportunity to, for lack of a better term, overcome those objections by kind of stepping back unemotionally and looking at the numbers, right? And, when you look at, okay, what do you think is going to happen to home prices? And what do you think is going to happen to interest rates? If home prices are likely to continue rising and actually perhaps start rising at a brisker pace again, if interest rates drop, and then that fuels demand, right? Because let's face it, vacancy rates are low. There's, renting is no bargain. So there's a certain amount of people that whatever the rates are at, they need to buy homes. So there's going to be demand there, and there's going to be greater demand with lower interest rates. It's just logic. And so I think that we're going to see another leg up here in real estate. And if that's the case, then the question is, all right, how do we bridge that gap, right? If we're selling our home and we want to buy another home, but we're scared by the payment, like, how do we bridge that affordability gap? Because, okay, my home will be worth more if I sell it in 3 to 5 years, but if the home that I'm buying is at a higher price point, then that's going to be rising at a faster pace than the house I'm selling. So I'm actually coming out further behind the curve if I sell in 3 to 5 years, if I'm a move up buyer. So a lot of times it's the affordability issue in the meantime, and that can be solved a couple ways, right? It could be solved. First of all, if I wanted a payment at 3,500 or 3,000, and the payment's 3,500, well, I've got a nice amount of equity sitting in my current home. So maybe I take out 15 or 20,000. I put 15 or $20,000 down less on the home, and then I take $500 a month distribution out of that account and move it into my operating account, if you will, that pays my mortgage, and use that to offset the higher mortgage payment for those first few years. Because interest rates are we're already seeing it. And I think that we're going to see an acceleration of the decline in interest rates. And so most of the folks that are buying today are going to have a very good opportunity to refinance lower in the next, I'm calling it 1 to 3 years. So if we're somebody that is going to have a need to move in the next few years, it's how do we just get over that initial fear, right? As I'm saying. And so there's a variety of ways that can be handled. And I think, as the gap narrows between the 3 or 4% interest rates and the 7, 6, 5.5, you'll start to get a point where, I think that some of these folks will start moving off the edge. And I think we'll see a little bit of inventory open up.
Well, I certainly hope so. First time buyers, though, they should be buying as long as they financially can afford to, because it's going to continue to be difficult for that grouping of people. We know there's not enough household formation, enough homes currently to fill all the new household formations that will be happening over the next 3 to 5 years.
Absolutely. Yeah. And that's a big, it's probably overused, but, like the best time to buy a house is 20 years ago. The next best time is today. When it's an actual need, right? And you're not looking at it as an investment, and this is like the roof over your head. And for many people getting their foot on the ladder of home ownership, so to speak, you can't find any 5, 10. Really the only declines when you get outside of local regional issues, right? Like San Francisco's in a bad way right now, right? Austin, Texas might be overbought. But in areas like ours, you go out any 3, 5, 7 year period, you're still going to see home price appreciation. The only times we haven't is 2008, which is a very specific situation that there's none of that backdrop here today, and the Great Depression. For the rest of the last 100 years, essentially, home prices have continued to rise. And when you look at the home ownership rate in the United States compared to a lot of places like Europe and some of these areas, we've got a much greater home ownership rate. So I think a lot of people take that for granted. And I am afraid that if we see another big leg up in interest rates, that many people, if they haven't gotten their foot on that ladder, are gonna miss that opportunity. So yes, if you can afford the payment, make it work. I'm telling a lot of our clients, I'd be looking at today's payment as a high watermark in terms of where you're at. And unlike your rent, which is going to continue to rise, I see a very high likelihood that your payment's going to be lower to quite a bit lower in the next few years as the interest rates decline, and some of these folks that are putting less than 20% down either eliminate or reduce their mortgage insurance as the home increases. So get that foot in the door, and that's definitely the message we're delivering.
So what do you think, 2024? What's your projection?
For home real estate prices, for interest rates, for it's abroad, for the overall.
Yeah, for pricing, for rates.
I think so for interest rates, I'll start there since it's kind of my wheelhouse. I think that, we're already down, we peaked out at like 8.25 about 6 to 8 weeks ago. Very product and client specific, but we're now kind of into the upper 6s, low 7s, worst case right now at the moment. So we've had a pretty good decline. My base case is in the next 12 to 18 months that through late 24 into 25, that we're going to see kind of mid 5s. So like low 5s to mid upper 5s is kind of my base case. If we hit a hard landing with the economy, I think there's a chance it could go lower. I think the like low fours, 3% interest rates, unless things really go to hell, I think those are kind of out of the equation for a long time. But it would be possible to see something in the high fours, I think, if we had a hard landing with the economy. But I'm kind of calling for mid fives. And the biggest risk to interest rates is this geopolitical stuff. If there was some sort of war that broke out, specifically like in the Middle East, or if Ukraine got worse because of a lot of the commodities that come out of that area, whether it's oil or grain, if we got another big push up in inflation, that would be not good for interest rates. So there's kind of risks to both sides, but I think we'll be down in those comfortably in those 5% in the next 12 to 18 months. Real estate can still be local. I know kind of the suburbs are responding slightly differently than parts of Philly. But generally speaking, I do not see price declines. Like some people are saying, I had a client recently, the aunt was in the background while I was doing a consultation saying, oh, they're buying at the top of the market. Let's check back in 2 or 3 years and let me know how that goes for you. And some would argue, they say, oh, I see home prices being marked down. My counter to that is no, in 2021, anybody could price something anywhere and it would sell, right? Because there was such a fear of losing out, fear of missing out, if you will. But I'd say now that the homes that are being marked down are just being marked down to the actual value, right? It's not an actual true decline in price. I think some of these properties are just coming back down to reality.
Yeah. So, Bill, real estate prices is based on what a buyer is willing to pay in today's market.
Yep.
So people will say, well, it was worth this at this time. I'm like, it doesn't matter. If you weren't selling it, it's worth nothing.
Yeah.
I mean, it's worth something, but it doesn't matter. It only matters when you go to sell today. And how many buyers are in the market at that time for that type of product. And the buyers make the market. We certainly don't. And we can look at comps all day long and think like, based on this, it should sell for this, but that doesn't necessarily mean that will happen. Because at the end of the day, I'm not buying the house, and neither are you. 100%. So the buyers get to decide what that number is. And we as brokers have to act accordingly and swiftly in regards to showings. Like if we don't have the activity, we can't bring a circus there. It's not going to make somebody else. Somebody buy
try if it works, yeah.
Oh, I've had sellers that want me to bring the circus. That doesn't work. We're just going to have a dog and pony show, and no one's going to buy the house anyway. But I digress. The buyers get to decide what that price is, and if we've exposed the property to the marketplace, for a few weeks' time, and the market's telling us they don't like the house because of the steps. They don't like the house because the yard's too small. Yeah, for the price. Yep. They don't like the house, the yard's too big for this price. Everything will sell at a number. Yep. And I always say, okay, well, the house didn't sell. Well, would it sell for X? Whatever X is always yes. I said, then it is always about price.
At the end of the day, you can't run from that.
It's always about price, right? Based on condition and location. We cannot pick up the house and move it.
Yep. Yeah, that's a great point. And I think also the thing that's especially first time buyers, who maybe their only experience was buying like a used car, right? And they're trained like, you don't pay the sticker price, if you will, right? And maybe a pitch for you guys, great agents like yourself, like, real estate is so much different, right? You've got agents out there, right? Either the agents are weak or they've got a stubborn seller, and sometimes the seller needs to see for themselves, but they're pricing high, right? And they're going to take a stab at that higher number. And then you've got some agents right now that are pricing low on purpose, knowing that this is the type of property that's going to get a lot of demand and the price is going to still get bid up over ask. So it's really, really important on the buy side. You're working with a great agent who's able to kind of look at those comps and kind of read the tea leaves, if you will, because you can't use some, formula for, well, right now houses are selling at this much of a discount, right? It's very, very situational and based on what the data is telling you. But yeah, I mean, I think so the price declines, I don't think are home price declines. I think that those are houses where people are still stuck in 12 months ago and they're actually getting marked down to, what those homes were naturally worth. But I think we'll see price disinflation, meaning we're going to still see home price increases generally, but at a much slower rate than we've been seeing for the last, up in, 20, late 20 and 21. So again, very local to each market, but I think we'll see low single digits or flat to low single digit price increases in most markets, and kind of tread water here and let the market catch up a little bit over the next 12 to 24 months. But I think that in a lot of these markets, if you see a sustained drop in interest rates, I think that I believe that, homes are going to continue to take back off. And as a real estate investor myself, I like to tell a lot of my clients, I put my money where my mouth is. And, right now I'm still buying with both hands where I can, because it's not just a pitch to my clients. I believe that home prices are going to continue their ascent.
I tend to agree.
Yeah.
Probably a couple percent. In some areas, though, tertiary areas outside of Center City, I think we will see still a decline in some of the pricing. The core areas usually tend in Philadelphia to hold tight. The tertiary areas of new development definitely are struggling.
Yeah, and that's why I multiple times here have kind of put that, asterisk next to like hyper local. And really, when you get into Philly, it's funny. I'll give you a quick. I bought a property, and they talk about timing is everything. I bought a property down on 21st and Titan, in Point Breeze in like 2006, and at that time, like Graduate Hospital and everything was making its way down, and that kind of line of development was kind of like a couple blocks north of Washington, right? And I'm like, man, this thing is going to come busting over Washington, and this thing's going to go gangbusters, right? And then when we had a tough real estate market, that's those kind of like up and coming developing areas I think you're talking about. Those are the first areas that tend to pull back. And so then I just didn't have to stay with it to hold on to that property, had to dump it around that time. And now you look, like 5 years after that, it was like the place had gotten turned into like a bar with like microbrews and stuff like that. And it was just, and I'm like, I saw this coming, but it doesn't matter because timing's everything. But specifically to what you're talking about, it's those kind of, you describe them as tertiary areas, those areas where it's kind of in the line of development, but it's not fully established yet. I think those are the areas, or areas that might be struggling with whether it's a crime or this, that, and stuff. I mean, those things are obviously wild cards that can't be controlled for as much.
Yeah. Also, new construction in those areas, cost of construction was so high, cost of land was so high that they had a price at these numbers, which I did a search, and there is a lot of projects that are not sold, not selling.
And that has that effect where, and I think that's another reason for why those areas get hit the worst, because in a different fact, it's one thing I talked about 2006, 2008, people didn't have the equity. Then you have these forced sales, right? And in the primary housing market, you're not going to really see that today because of all the equity that people have. But when you've got developers or flippers or these types of folks who are using leverage to speculate, right? Even those are the folks that are prone to those like forced sales and liquidations. And anytime you have that stuff going on, that is going to so already the market's pulling back some of those areas. But then when you have a handful of people that were in there paying top dollar because of where things were going, and those people get liquidated or have to kind of force sell, then that kind of puts an extra downdraft on things, and kind of resets the market. But for the folks that are willing to catch a falling knife when things stabilize, I think they can start getting I think the trend in a lot of those areas is still the direction it was going. So I think that, the question is when do you jump back in? So.
Well, there's going to be, there's other things too, right? So we look at the cities. I hate to say that I predicted during COVID that people would move out of the cities into the suburbs. It was people wanting to have, be closer to family, have a big compound, not be stuck in a little house, work from home. So we have cities now, not just Philadelphia, where, there's 25% vacancy rates in the office. It is and will cause, we don't live in a vacuum, right? So there will be some setbacks from that. And we have a lot of commercial buildings with no tenants in high rent areas, Walnut Street, Chestnut Street, down in Core Center City. So that does take an effect on pricing as well. And buyer sentiment of, everything else that's happening in the world, right? We got Middle East and Ukraine and Russia. And expensive things are expensive. And, I think still there's even like a hangover from COVID.
Absolutely.
From mentally.
Yeah.
So we don't live like in this vacuum of like, okay, here's what it is. No. As a real estate broker and mortgage broker, we live in a land of, we have to look at everything holistically, individually. You can't blanket over things and give everybody, oh, well, you should do this because of this. No, it's an individual conversation. It's not, one thing to all.
I think that's a huge point, Maria, that, is that, and I say it all the time, and this might sound like, again, a pitch for folks like yourself and ourselves, but, you can't, yes, you can look at the data, right? You can study the data, you can kind of understand the themes and be able to give people good advice and guidance based on kind of the macros, if you will. But I think a good real estate agent, I think a good mortgage provider is an advisor, and not just for you guys, somebody that's just letting people in the door, or for us, somebody that's just quoting an interest rate. And it's a person that really gets under the hood with those folks, understands not just what they're trying to do today, but what's kind of going to be important to them in the future, because all of these things are going to be, very, very unique and specific to the individual. So while there may be some general themes that apply to most, absolutely, there's going to be some specific situations for individuals. And, when you work with somebody who's not tied up in the result of any one transaction, that's able to give kind of unbiased advice, I think that's really, really critical. And just the retail thing, I think, is a huge issue that I think is bigger than people realize. I don't think, even though you're starting to see some return to work, I think that has changed forever in terms of hybrid and things like that. And I don't think anybody knows where the bottom is on commercial real estate right now. And I think that so much of commercial real estate is tied up in like short-term 2, 5, 7 years that I don't think we've actually seen. I don't think we've seen the worst of it, because as
We have not. No, we have not. It's a long runway.
Yeah.
It's a much longer runway because the expiration dates, from, say, if they got something right before COVID, is 5 years.
We're right. The next year, is when a lot of those 5-year resets are going to be happening. And just like I talked about how rates drop in residential, that increases demand. So there's definitely some correlation between interest rates and prices within residential real estate. But of course, residential real estate, as you know very well, is still going to be comp based. Commercial real estate is almost entirely driven on cash flow, right? And so you've got these properties that, a 2019 note is going to be most likely coming due in 2024. And you've got all this vacancy there. And these properties, some of them might be worth, 30, 40, 50% less, right? And now you can't refinance. I read recently a stat that most bankruptcies, corporate bankruptcies, aren't the business going out. It has to do with refinancing balloon notes, right? That's the biggest thing that drives people into bankruptcy, because these folks aren't going to be able to go out and get new debt to take out the ones that they took out. Didn't that mall just do another bankruptcy down in Philly? I forget the name of it, but they went into like the third time or something. They've gone into bankruptcy since they opened.
Fashion.
Yeah, I think that's it. I just saw an article about it, but so yeah, I mean, it doesn't mean that they're totally illiquid. It just means that they can't pay off the debt that they took out, and so yeah, I think that's going to be. And then the question is, does that cascade into the smaller regional banks that typically lend in that space, and does it cause another credit crunch? So to your point about like we're in a new world, while I think we can always use data and make, again, good overall decisions and generalizations, I think the clarity on the different direction things are going to go, I think naturally is far less now, because there's so many of these interconnected things going on at the same time. So you have to stay nimble and pay attention to the data, because it's very touch and go right now. There's all these different factors at play.
Prepare for the worst and hope for the best.
I live by that.
Let's switch gears.
Yeah.
Let's talk about our industry and what people can do, whether you're a mortgage professional, real estate professional, to really take advantage of the opportunity that is in front of us, meaning how to grow in a downward, I want to say economy, but we've had we'll probably close at just under 4 million sales, which on the real estate side is 8 million sides, but there's about 2 million real estate people, licensees. So do the math. That's not very good. And the same thing on the mortgage side, you only have the one side. What do you think are some things that can help salespeople grow during this time?
Yeah, that's great. It's funny. I was just talking to our mutual friend Jay Duran about this specifically last night, but I could talk about it all day. I would say, right, that there's still some window to it, but I would say the biggest thing hopefully has already been happening, right? And so anytime you've got a down market, it's challenging for a lot of folks, because it's easy to do activity when you guys are closing deals. It's easy for us to do activity when we're, closing loans, right? Because you see the direct result, your bank account seeing the direct result. But, the challenge is digging in and doing the activities when the results are less apparent. And I think any good operator of a business during downtimes is using that opportunity to improve and up-level their deliverables, their service, their systems, and doing things that you're not going to be able to do and have time to do when things are really busy. So I'll give some examples of what that looked like for us. We would do post-closing calls or annual review calls, but I would do them more sporadically. Oh, this person's a good fit for that. We added a team member this year. And so 100% of the time we do a post-closing call. So we're not just getting you in the house. We're talking about what the future might look like, and we're setting ourselves up in advance of that, whether that's buying and selling, selling this property and buying another one, an investment property, or just preparing for rate drops and things like that. So, we've built that in as part of our system. We used to only do upfront underwrites, TBD underwrites, sporadically, again, if somebody was in a highly competitive market, or if the file had some hair that we wanted to hash out up front. But now we've trained a team member up, and doing upfront underwrites is a consistent part of our process all the time. I wanted to do that for years, but I didn't have the time when things were crazy in 20 and 21. And so I think using time when overall volume is down to look at what are the things that you want to implement in your business, and creating those new habits and creating those new systems so that they're already in place when the market turns. So that would be one bit of advice that I would give. Database management is something that goes the wayside when deals are falling from the sky. Getting really, really good at your database management is a great thing to do during down markets. And then the biggest thing, and this might look a little bit different for mortgage and real estate folks, but not really. The idea is the same, which is being a problem solver. Right? Like identifying what that particular pain point or few pain points are in the market.
Be the solution.
Oh, And that wasn't even planned, Maria. And that's it, right? Because both of our industries have these outside forces that are trying to commoditize us, right? There's the discounters in your space, there's the online lenders in our space. And the question is who's going to win out, right? If all we do is do the same things everybody else does, then all it's going to come down to is price. But if we're really able to be educators and advisors that help people through these huge transactions, then that's where I think that we can all thrive. And so, that changes for us. A year or two ago, it was getting offers accepted in 2021, right? So we came up with the bulletproof buyer, these series of things that we did in advance that made our offer acceptance rate significantly higher than our peers. For a while, it was contingent sales. How do we solve the contingent sale issue of people that aren't going to win with a contingent sale? And how do we address that? Solutions for that. For a while, it was the affordability issue, right? And again, everybody hopped on, but we were out very early in a seller buy down strategy, right? Like, how do we, if we feel that prices are going to rise and we feel that rates are going to decline, and it's just in a short-term affordability issue, how do we not just offer the product like a lot of people do, but put a presentation together that helps the buyers understand it and feel confidence in making that decision as a solution to their problem? So I think that there are a few things that are evergreen, but at any given time, each of our markets have kind of those one or two hot buttons that is really kind of front and center to people's minds. And I think it's coming up with solutions to address those problems is where you'll create separation from your peers. And when you have tough times, just realize if you're a good operator that the folks that are hiding under their desk are having an even tougher time. And I'll kind of end this part myself with, in the beginning of this downturn, I told my team this story about two guys walking down a path. They came upon a bear, and the one looked down at the other one, and he was tying his shoes, and he said, "What are you doing? You're never going to outrun that bear." And he said, "I don't have to outrun the bear. I just need to outrun you." Right? And so just continue to do the right things, continue to improve what you're doing, work hard, and just realize that a lot of these folks that came in for the easy money over the last few years are falling off, gain market share. And as that market turns, you'll be in a great position to capitalize on it.
Yes. Do more. Be more.
Work
on personal development.
Yeah.
One of the things we spoke about yesterday in our business development meeting for 2024, I said, be a human. Talk to people like a human, not a lead.
Yeah. Sometimes
that requires less asking salesy questions. We know certain things that we need to find out. But I called an expired listing. I was on the phone with them for 20 minutes. We talked about a lot of other things other than real estate. And it was, and also like mirror and match the people you're speaking to. So don't be like da 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 da, and they're slowly talking. Right? Yep. So, and it makes the people, it's not like a tricky thing. It makes people feel comfortable. You want them to feel comfortable so that you can show them, they can take down the sales guard, right? Sales skepticism. And you can show them that you can help them by asking them questions, being a human and not a sales robot. I think that's one of the biggest things. Because when I call the expires, they get tons of calls. And I said to this guy, I said, Todd, I'm only looking for the people that want my help. So it's okay if the other people tell me, F you, go pan sand, because they're not the ones that want my help. See, I know that I am the solution. And I know that if I don't reach these people, they're going to be stuck with a bad situation again and not sell. So I'm only looking for the ones that need my help. And when you start to think about things like that, I'm not looking for everybody. only looking for the ones who want my help, the ones that want to argue with me on the phone and this and that. Okay, no problem. Have a nice day. I say happy holidays, and not sarcastically. I genuinely mean
Yeah.
that, right? But I'm not looking for all. So say I talk to 10, I'm only looking for 2 or 1 from the 10. We'll say 1. So how many 10 do I need to talk to? We just closed and put under contract yesterday 2 of these that were expired. They both Spanish speaking customers. And Clarice, my EA, she's all Spanish. So she was my translator. And I don't think they would have sold with anybody else. I don't think it would happen. But Clarice did her part, right? Everybody has to do their part, meaning everybody has to be engaged with the client, the whole team, whether it's like the transaction, Andrew or Dara or me or Clarice or one of our agent partners. We all work together. Teamwork makes the dream work.
Teamwork, yeah. Well, that's even though we're on here and I've done this a long time, that's great advice you just gave. And I'm as you're sharing it, I'm guilty of it. You've probably noticed in a short time, I can get in my head with the numbers, and I love the data. And there's a certain segment of people that really hits with, right, and they feel comfortable understanding those things. But I'm guilty myself of sometimes not meeting that person where they're at. And it's not that it's some sales ploy, right? It's just that you're helping people through this huge.
Well, you have your own agenda.
Yeah.
It's nothing bad towards them, but you have your own agenda. So you're going for your own agenda.
Yeah.
Problem is that we lose 75% of the people that way.
That sometimes people, they need to trust you first before they will listen to the things that are coming out of your mouth, for sure.
Especially the ones like I talk about, like the expireds, right? They just didn't sell. They're annoyed. I don't blame them. They got bad advice. They put the wrong price or couldn't show it, or there's like a whole thing of stuff.
They're already skeptical.
They're already. And even people that call the office with sometimes just about to sign. Everybody's always like, they feel like they don't want to get somebody get over on them.
Yep.
And it's they want to feel like they can really trust the person.
Yeah.
And so what I have found is when you're just working heart to heart, it changes everything.
Yeah, I think that's great wisdom.
And you actually have like a better day. And I know about things not happening right now, right? You have to do the work. I said to the team yesterday, Bill, I only will focus on today, what I can do today. And if our thing is that we have to make X calls, so it's 20 conversations a day, that's it. You do that, you're good. Checked off the boxes, only today. Forget about the week. Forget about next year. Forget about all of it. Win the fucking day.
You win the day.
And if everybody just won the day. But you know what happens, Bill? This real estate is the most important real estate you have. More than your home, more than any investment, is right here.
Yep.
Between your ears. And if you can't protect this, I call it like the drunk monkey. He comes out early in the morning, in the middle of the night when you wake up. You're not enough. You're not worth it. You need to, No. I say, and I explain this to them. I said to the staff, I said, listen, I have that thing too, but I got to remember who the F I am. And so do you. You have everything you need. It's here. It's in your heart. Show your heart. And when you do, your life will change.
That's beautiful. And I think it's great wisdom. It's so many, it's a series of little wins builds momentum, right? Rather than try to knock everything out of the park and focus on 1 year, 3 year. I mean, you have to do that type of stuff, but your what you shared on just winning the day, right, is I think so critical.
I have no 3-year plan.
Yeah.
My plan right now is to win the
Kick
M
ass
every
every
day.
day.
And that is it. Because you can write all the plans in the world that you want. And then when you don't hit them, because you didn't win the day, what happens to people? They become discouraged. They give up. They feel, woe is me, blah, blah, blah. And it's too much. It's too much to think about all that because it's fear and overwhelm stops action. Most people live in fear and overwhelm. I have to do this. I have to do that. Oh, I want to do, nope. What do I got today? Check it off. And that's it.
So much simpler too, right?
That's it.
Just
I'm just going to be, that's it. And every day I'm saying the same thing. At some point, the next person will get it at some point.
well, I came on here to share some stuff, but definitely walking away with a few nuggets myself. And these are things I've heard over the years, but sometimes we just need a refresher on it, right? I'm definitely guilty of getting stuck in the future and grand plans. And I mean, I implement a lot of that stuff and what's my priorities today. But I think that laser focus that you're sharing, in particular in a time like this, prevents a lot of that overwhelm, right? Like just what I got to do to knock it out of the park today. And you do the same thing next day and you string together a series of wins. And the next thing you know, you got momentum behind you.
Oh yeah. The big Mo.
Yeah.
I could talk about that all day. But Bill, it was great having you on the show. Thankful and grateful to have met you. So thank you, Jay, for the introduction to Bill. You definitely know your mortgage stuff. I know my stuff a little bit. So I agreed with a lot of the things, mostly all the mortgage things, of course, you said, because I know what's going on. But I think we're going to have a good 24.
Let's do it. I know we can. It's all in our control. There's going to be people that are going to have it, right? It may not be everybody, but there'll be folks that will. So it's just our job to make sure we're one of those people. So
go get them. Giddy up.
Yep. Well, thank you so much for having me. And this was a blast. Let's do it again sometime. And
My pleasure. Yeah. Bill, it was great to see you.
Take care.